Hello and welcome to the Harwood Report for September 4th, 2017. The Harwood Report is presented by Trade Academy. I am Keith Harwood, the founder of Trade Academy, and your host. Let's go through the disclosures as always. All services and content are provided for educational and information purposes only and are not intended as legal or financial advice. Please read through the rest of this slide. Trade Academy is not an investment advisor, is not registered with the US SEC or FINRA. Do your own due diligence before you enter into day trade. Options and trading have risk. This week we're really going to focus on some very similar stuff to what we've been looking at the last few weeks, partially because I think the dollar-yen has been one of the most interesting trades, and it's been giving some clean signals. I'm going to run through the equity indices and in particular show a little bit of what's been going on here since North Korea has announced their expectation that they can put a hydrogen bomb onto an ICBM. And sort of a lack of reaction overall, honestly. And after we go through the dollar-yen and the normal correlations that come with that in gold, the miners, and treasuries, I want to look back at energies, and in particular the MLPs. I think that the most interesting trade for the energies is likely in the MLPs, and I think that's where there's a justification for kind of taking a look there at some interesting trades. So quickly, we'll run through the equities here. S&Ps were pressing towards new highs on Friday. We got within a buck and closed relatively unchanged, though. All the key moving averages are below here. You know, if we can't make a new all-time high, it's likely that we retest 245. That's not that interesting of a trade, frankly, in terms of options. The thing that I think is interesting here, though, is let's look at the reaction from the futures with the North Korean news. So you saw a little bit of a pullback. If we go to an hourly chart, you can see that we gapped down. Not very much, opened up around 24.60 after Friday's close of 24.74, so less than 0.5%, or right around 0.5%, and we've basically drifted a little bit back higher. The one that's had the biggest comeback is actually the small caps. If you look at the small cap futures here, the gap lower, and now we actually made a new high instead. So frankly, the markets don't really care much about what's going on in South Korea. So let's go back to SPY. Again, no, Friday was an unchanged day. There's nothing too crucial there. I think if we fully recover and open above Friday's low or open just below and then come back above Friday's low, then you're going to likely see us press towards new highs here above the 248.91 level, so 249 plus. I wouldn't trade this with options. It's just sort of an indicator of whether you want to be looking for generally long entries or short entries. And I think that given the lack of response from North Korea, the market's generally going to be looking for long entries here because I do expect us to complete the recovery from the gap down on Sunday evening's trade and into Monday. NASDAQ is going to look very similar to S&Ps, made new all-time highs, and then closed just below on Friday. Dow Jones, a little bit shy of the all-time highs. And finally, small caps, we know that those have been a little bit of an underperformer, and that may be in part why the futures actually are up after the North Korean news. Now, this has a little more upside towards 144. So if you're looking for an overall market exposure, it seems like small caps are looking to play a little bit of catch up, especially in the futures in the extended hours Sunday evening and Monday with a little bit less liquidity time. So maybe there's something in IWM. Volatility is low. You could look at this week's 141s or 142s looking for a catch up towards 144. But I don't really think there's anything too exciting here, so I don't want to focus on the overall big stuff. I want to look at our big indices. I want to look at dollar-yen. This has been the one that we really keyed in on, and there was a significant change last week. I've been talking about how as long as we stay below the 10 and 20-day moving average, I think you should be leaning towards this continuing to fall. But we had some consolidation for almost a full week. And then last week, we rallied through the 10-day and then through the 20-day. So we've been above the 10 and 20-day for a few days. This is the evening reaction to the North Korean situation. We're sitting right on the 10 and the 20-day. The 10-day and the 20-day are about to cross. The 10-day going above the 20-day should be a signal that there's a little bit more momentum to the upside. if this can hold above the 10 and 20 day after this, negative news coming from North Korea, and that should be confirmatory that dollar is going to continue to rally against the yen, risk on, and gold should be weak as well as miners, and so would TLT as bonds should start to weaken and yields start to rise. Let's look at GLD's chart though. In spite of that relatively strong dollar yen, gold had a nice day on Friday. I guess on Thursday and a little bit into Friday. And if you look at the after hours, the futures the futures should change thanks to North Korea. We got another about $10 out of gold from 1330 up to 1340. So that'd be another dollar in GLD. It's been strong, obviously. You've got to watch this closely, even if dollar yen is strong. If gold continues to rally sort of against that dollar yen trade, then it's going to be hard to make money on any bearish plays in the precious metals or the miners. But I think that if dollar yen continues to strengthen, then you will start to see some outflows from gold, which has been a favored trade recently, and actually pull this back. 10-day moving average easy, probably the 20-day, and maybe even down here towards the 50 and 100-day moving average if you get a real liquidation out of gold. So that gets us into our first trade idea here, I think. The way that I'm looking at this is that the miners did finally catch up somewhat. They're not quite up to where they would be if gold, or given where gold is, I would have expected them to push towards 25.5 or 26. But at the end of the day, if gold liquidates, so will the miners. And so if we open above Friday's highs, I would expect, given the move in gold futures, probably open up here right around 25, maybe a little bit lower. On a fade below Friday's high, which was 24.87, as long as the dollar yen continues to be strong as well, which I expect that to go kind of in tandem, then I'm looking at a potential of a move back down here towards the 200-day moving average of 22.5. Very simply, we should get to the 10-day moving average. There's not a lot of might to be made on that move. You're looking for the move below the 20 and towards the 200. Apologize here. We got to go over to the gold to GDX. So in GDX, if you look at September 29th expiration, I want to get a little bit of time here. Over the course of the 4 weeks-ish, we would normally see about a 6% move. That should be about $1.50 and gets you down towards 23. If you want, you can go a little further back, but I kind of like this time frame looking at the 24s here. You got about 3-to-1 R&R out of the 24s. So that's a pretty good return. If we look at the vol over the last 6 months, we're trading still near the lows on the vol, so you're getting a good edge on being long volatility. On the other hand, if the market does decide that the situation with North Korea is a problem and we start going more risk off, I like the junior miners a lot more. So this would be the way I would play the long side, would be via the miners. They have a little more catch up to do. 38 and even into the low 40s would be well within reason. You could get a spike higher in these, especially as they start to play catch up after lagging gold, silver, and the major miners. So where I'm looking at on those, is to go over here a little bit further back and go into maybe even all the way October. If you go all the way back to October, the normal average daily move is about 2%. This is going to be 1, 2, 3, 4, 5, 6, 7 weeks. So roughly 34 trading days with the shortened week this week. So you should get around a 12% move. Square root of 34 is roughly 6 times the average daily move of 2%. So that's how you get to the 12% expected move. That'd be a little over $4 and a move towards 41. That hits with our target there that we were talking about, is that potential of getting around here to 41, which is the highs from February and March. If you've got fear and gold miners play catch up, I think that's well within reason. Given that kind of move, looking at the 39s, 3-to-1 R&R, 40s only have about a 2-to-1 R&R, 38s have about a 3-to-1 R&R. So I'm kind of looking at these October 39s as where I'd be playing. I think that's well within reason. So this is really the two options then for my trade. Again, would be watching the dollar yen and knowing that if we can't hold above the 10 and 20-day moving average, You're looking at the bullish side of the junior miners, and if we do hold above the 10, 20 day, then I think you've got to look at the bearish side of GDX. And the key here is still that this volatility is very cheap in both GDX and GDXJ. We've seen GDXJ trading closer to 38%, and back in February or early March when we were making our highs, volatility was close to 50%. And right now it's 29. So that gives you a little indication of just how cheap volatility is, especially if we get into a risk-off mode. This has got the bigger leverage. GDX, I think, does have the higher probability, though, if the market just recovers and shrugs off North Korean news, as it has time and time again over the last 9 months. Finally, just another indicator of, I think, the one that's actually paying attention to what's going on at dollar yen there. So TLT did fade on Friday. I do expect that to open firm as well, given what's going on in North Korea. So if on the open, we'll probably see TLT firm. This is probably this is a little bit of an easier play because you do have some cleaner stops above, and it's shown some weakness already. So you should be able to see some people press this lower relatively quickly. And the volatility is relatively cheap in TLT. But that's, volatility, I think, across the board had gotten hit on Friday. Down 9%, though, is pretty cheap. And you can look again towards probably September 29th, try to stay under 9%. And you're looking for anything around just below the market here in the 26s or 25.5s. This is not as big of a leverage trade, which is why I liked the GDX trade better for the downside and the junior miners for the upside. TLT just doesn't quite have the same leverage for the break, given that volatility's upside, it's probably closer to 11% versus so 2%, or a sort of a 20% rise in the actual implied volatility level is nice, but it's not quite as significant as what you've got in the junior miners, especially if you're going into a risk-off mode. The other thing I want to look at here is oil. I'll start with crude futures here just to give you a little bit of a graphical representation. Again, it's been kind of a choppy trade. There's nothing that I see that's too enticing there. But if you go into XLE, you see that, as I talked about last week, we started recovering. Now we had a really good, strong day on Friday in XLE. Got above both the 10 and the 20-day moving average, starting to create a little bit of a base here. I really wouldn't be surprised to see us retest the 100-day moving average at 65.75 roughly. That's been tough for us to get through. But prior, in the past, we were using the 50-day moving average as resistance, broke through that at the end of July, and now I expect to see the 100-day as the key resistance level for us, which that's $2 of upside. You can look at it in the various subsectors of the energy sector. You've got the oil services, very similar, not quite up to the 100-day though for the upside. If you go to XOP, it's oil and gas exploration production. Again, same idea, 50-day didn't really hold last time we rallied, and we pressed towards 100-day. Finally, the one that I think might be most interesting is the MLPs. Part of the reason I really like to look at the MLPs here is you can see that this had a much more significant drop below the 10-day, and now we're starting to get a little bit more momentum. The slope of that 10-day moving average is getting pretty steep here as it starts to catch up towards the 20, and we had a really nice move, 3-day move here, moving from 10.75 up to 11.25. We look at the volatility levels, and this is what the other part that really gets me more interested in MLPs is XLE. Yes, volatility is near the lows here. 15% is kind of the low end of the implied volatility range, but realized vol is only 10%. Go over to OIH, and we see a very similar picture. We're below the low end of the implied volatility range, but realized vol has just been trash, 18%. XOP, same idea, 26%. We're at the low of the range. Realized falls at 17%. So you're not getting any money for gamma there. If you go into the MLPs, while it's not quite at the low end of the range, obviously you'd love to see implied vol at 13% to buy there. Realized vol has been around 21%. That's kind of what we were seeing there, though, in that chart where we've got these big moves relative to the normal implied volatility. On Thursday, move of what, about almost about 25 cents, so that's 2%. That's well over the normal daily move of about 1%. So where I'm looking here is the October 13th. I like the weeklies because you've got you've got 50-cent strikes, whereas if you went into October, you'd have dollar strikes. And the other thing I like about this is that you get a little bit more gamma, obviously, by going a little bit shorter term. I've already typed in 17% here just to give us a little indication of where this would be if we're kind of in the middle of that range. Do a little bit of a simulation. If we get to the high end of volatility, that'd be around 19%. And you can see that would put the value on these up about 3 cents to 16 cents. So it's a tight range, but the value is roughly 13-ish, 12 to 13 cents. There's just not a lot of trade in this term, so there wasn't even a nickel bid yet. If we get a continuation of this move and we realize vol at, say, 16%, it's 1% per day. We have about 1, 2, 3, 4, 5, 6 weeks until these expire, which is around 30 days. So you would expect a roughly 5.5% move. 5.5% puts you at about 65 cents and puts you towards 11.90. You can get these for a dime. That gives you about a 4-to-1 R&R. And if we look back at the chart on AMLP, 11.90 is right here in the last area where we consolidated and just above the 100-day moving average. So I think that's a really good potential place to target as an overtime rally. If you get to 11.55 next week, that might be enough to justify taking some money off the table. But if you want to play for a rally in the MLPs, I think this is a really good spot to play at. The 11.5s for 13 cents with 6 weeks to expiration just gives you a lot of leverage for relatively cheap here. All right, so that's really it for the Harwood Report for this week. Just to recap, I really think that there's nothing major that you want to play in the major indices here. I mean, S&Ps have recovered from the overnight lows after the North Korean news, as NASDAQ, and the Russell has actually already exceeded Friday's high, but it has been lagging over the last few weeks, if not months. Dollar yen has shown a lot of strength. It shows a little bit of weakness into the evening hours of Sunday night and Monday morning, but if the markets shrug off North Korea, this will continue its strength, and I think that's where you get some nice hit in gold, the miners, and the junior miners. If it continues to be strong, if the dollar continues to be strong, I'm looking at bearish plays in GDX via some late September 29th puts. If the dollar yen continues to be weak and North Korea is taken a little bit more seriously, that's where I'm looking at those junior gold miner calls. Because those, again, have a lot of leverage. TLT, it doesn't have quite as much leverage, but it's probably got some probability there because we know that the correlation between dollar yen and TLT is a little bit stronger. And then finally, in the sector indices, I really like the MLP calls. Looking from each subsector of the energy, this seems to be where the volatility is kind of going, and you've got a decent upside for really cheap leverage. So this will probably be my main focus this week is the MLPs is sort of my favorite trade of this week, with the miners obviously as sort of secondary trades, with bearish the gold miners and maybe bullish into the junior miners as an alternative, dependent on how the dollar yen reacts on Tuesday. So we just got to key in on that on Tuesday to determine whether the bearish play or the bullish play is going to win out. Contact me. The website, tradeacademy.co. Email me, keith@tradeacademy.co. Feel free to call me, 312-600-8004, and follow me on Twitter @tradeacademyco. As always, I post a lot of watch lists and some ideas midweek, so I can keep you guys updated. Hope you enjoyed this week's Harwood Report, and we'll talk